Hello and welcome to Business Standards Morning Show. I am Ruchika Chitravanshi and let us take a look at the stories for today. In a worrying development that could potentially hurt the Indian IT sector, high attrition rates are haunting the country's big IT service providers. The war for talent has become an industry wide phenomenon amid an acute shortage of digital skills. Let us look at the reasons for high attrition and the actions the companies are taking to tackle this.
If you are an IT worker in India, there is a chance you would have contemplated switching jobs in the past year or may have already done so. India's biggest IT companies are grappling with a talent crunch which they expect to persist for some time. The country's top 4 IT exporters, Tata Consultancy Services, Infosys, Wipro, and HCL Technologies, reported a steep rise in voluntary attrition in the July to September quarter. This threatens to weaken demand, which has been quite robust in the wake of the coronavirus pandemic outbreak, with global businesses accelerating their digital transformation. The trailing 12-month attrition rate at TCS, although the lowest among the top 4 at 11.99%, is a jump from 8.6% in the previous quarter. Infosys, Wipro, and HCL Tech saw their numbers touching new highs of 20.1%, 20.5%, and 15.7% respectively. Nasdaq-listed Cognizant, which has the majority of its 3 lakh employees based in India, witnessed an attrition rate of 31%. Giving an indication of how bad the situation was, Infosys COO Pravin Rao said that he had not seen such a scale of war for talent in his over 3 decades of experience in the IT industry. Speaking to Business Standard, Wipro CEO Thierry Delaporte said the attrition rate was higher than what the company would like it to be. This is what he had to say on the situation.
Attrition is higher than what I would like it to be. I take no comfort from the fact that, this is not specific to Wipro, it's the same for every competitor of our industry. It's actually true for our clients as well. And so I think it's a broader issue that, our industry is facing. Having said that, I would say, while we obviously are working on ways to reduce this attrition, we also prepared for the fact that it's going to take some quarters before we see a material reduction of attrition. So we have geared up our supply chain, our hiring engine, in order to adjust and hire the number of talent that we need to support the growth we are acquiring at the moment.
Several reasons can be cited for a shift in employees' mindset. This phenomenon is not limited to just the large service providers, but is also seen at their clients. Companies are seeing most of the resignations at the junior level. For some of this, the industry has itself to blame. Entry-level salaries have been stagnant for more than a decade, and the majority of the attrition is taking place among employees with 3 to 6 years of experience. At this experience level, their salaries increase considerably when they switch jobs. Former Infosys CFO TV Mohandas Pai also said that it made sense for freshers to switch companies after a few years, since their salary hikes at the existing company were linked to their pay at the time they joined. Despite the current situation, Infosys says it does not see the entry-level salaries dramatically changing in any way, since it invests a lot in training freshers so they become productive. A significant part of IT companies' growth is coming from areas like cloud computing, big data, artificial intelligence, machine learning, and cybersecurity. There is a severe supply deficit in these areas, which allows highly skilled workforce to constantly shop for better opportunities. According to IT industry body NASSCOM, India's demand for digital talent jobs is 8 times larger than the size of its fresh talent pool. By 2024, this demand is expected to become 20 times the available fresh talent pool. Established software firms are also losing employees to the new age startups, which are in their hyperscaling phase. Flush with funds, startups are drawing software engineers by offering above market salaries, flexible work arrangements, and generous employee stock options. Though it may be an extreme example and an aberration, payment startup BharatPe is even offering super bikes and gadget packages to new recruits in its tech team. What is also helping employees seek newer roles is the normalization of the work from home model after the pandemic. Technology professionals are able to easily explore other career prospects as the recruitment exercise has gone completely virtual. What are the companies doing to tackle their high attrition levels? They are rushing to campuses to hire more freshers. Many have already raised their hiring targets. Infosys is hiring 45,000 fresher graduates this financial year, up from its previous target of 35,000. TCS is onboarding 78,000 freshers, a big jump from its previous estimate of 40,000. It has already seen net addition of more than 75,000 employees in the first 2 quarters of FY22. Wipro has also raised FY22 fresher hiring target from 12,000 to 17,000. In all, the 4 IT giants are looking to add over 160,000 freshers this financial year. The companies are also targeting retention of employees with niche skills. In the past few quarters, they have announced salary hikes and promotions. To increase retention, Wipro is offering new recruits a 5-year plan of compensation growth that is built into their contract. Infosys said it had focused a lot on employee engagement, staff mobility, and introduced new posts such as digital specialist. Nevertheless, the companies expect the attrition rate to increase in the next few quarters before cooling down.
Passenger volumes on the Delhi metro are still 45% of their pre-COVID level. But what has come as an additional challenge is an adverse arbitration award which could lead to an outgo of Rs 7,000 crore. Business Standard's Jyoti Mukul spoke to Delhi Metro Rail Corporation Managing Director Mangu Singh on these twin challenges.
To start with, I would want you to give us some idea about the traffic volumes on the system.
Today, we are running all 100% trains with full capacity as far as the number of trains are concerned, the frequency is concerned. But because of the restriction on number of passengers inside the train, today we are carrying around, on an average, around 25-26 lakhs per day, as against around 60-65 pre-COVID scenario.
When you say that change in number you will have, are you trying to say it's just because of the restriction on the number of travelers that the number is still down, and in the common perception, the fear factor of COVID has gone away, maybe due to vaccination?
The people have to come out from their home. They have to go for their job. They have to do the work. They have to earn the bread and butter. And therefore, they are out. You see outside, there is no difference you see the market, the road, everywhere the people are there. So the same thing will be true with the DMRC also, finally. So today, number of passengers are less. This is mainly because of the restrictions.
As far as your revenue goes, have they come back to the normal level?
We have not back to the normal number of passengers as yet. It's still around 35% or so. The same is true with the revenue also. Revenue also is not, we are not back to normal. We are still far short. The only good thing is that though the number passengers are only 35%, but as far as revenue is concerned, we are almost 50% of what used to be earlier. Average journey distance is more now. On the non-fare box revenue side also, it has hit very badly because all the retails, all the property development inside our stations, they have also hit very badly. It's very easy to insist on same terms condition as used to be earlier. But then the scenario will come that these people will leave. We will have a situation where there is no revenue at all. So we have been very reasonable with them. We have adjusted the rental during this period.
Last year, you had asked for some relief from the government in the sense you wanted that the loan which you are paying back to the Japanese line of credit should be, there should be some moratorium on that. Have you heard from the government on that?
The current problem of shortfall in the revenue, last year we projected a loss of around 2,100 crore. But when we finally closed in the March this year, we have been able to improve upon some revenue and also improve upon on the expenditure part of it. So we are short by about 1,700 crore last year. These are the audited figure, 1,700 crore. Similarly, the situation is not yet normal in the current financial year also. So this year we have anticipated around 1,500. So this around 3,200 crore, this has to come from our stakeholders, the equity holders, the two government. In fact, not two government, but the four government of Haryana and government of UP also, because the network is spread over NCR area. And the sanction order, a cabinet decision on all sanction of these projects. Cabinet order very clearly stipulates that if there is a financial loss, if there is a loss during operation, how this will be shared. In case of phase 1, phase 2 line, it was mentioned that it will be shared equally by the two governments, central government and the state. While in phase 3, the policy of the central government is that the loss to be 100% borne by the state government. So based on that, on the pro rata basis, we have worked out a pro rata share to be borne by the central government, by the government of Delhi, government of UP, and government of Haryana. And that we took to the last board meeting, and board then cleared. And based on that, we have now written to all the four government, make good that losses.
The arbitration award of 7,000 crore plus, which is, I think, increasing every day because the interest is mounting. So how have you discussed this issue with your joint venture partners, and what is the overall sense that you're getting with Delhi Metro be able to overcome this burden at a time when it was not really in best of business circumstances?
Right now, the situation is that we have filed a review petition in the Supreme Court. Since the matter is sub judice, I will not make any comment on that.
You had taken over the Airport Express line, which was a privately run metro system, and then you have this situation of a case on you. You're also running the Gurgaon Metro, which was with ILFS joint venture, and I understand the contract arrangement is different in case of Gurgaon Metro. This tricky issue of who funds the debt which is there on the airport line. At the end of it, it is a public sector company which has been left handling these two.
As far as airport line is concerned, this line is not in loss. We have not taken over today. 2013 itself we have taken over. So from 2013 we are running the line, and the line we ran in operational profit till the pandemic. So before pandemic, the line was running in operational profit. So there was no issue as far as running of the line is concerned. And we are very confident that after the pandemic is over, the running will not be an issue. But what will happen to a private player? He will not be sure what will be the fare after 2 years, 3 years, and 4 years. And here we are talking concession period of 30 years or 40 years. So for a private player to take that risk, even if you allow the fare revision in your agreement, but you see in real term, in practical term, how much objection you will have from the public, various other organizations, NGOs, the likely PILs and things like that. Even a private player, even if you have a provision in your contract, he will not have free hand as far as the fixing the fare. And this is exactly the reason why the PPP and the public transport system like Metro has not been very successful. That is one. As far as finance is concerned, the finance to a private player is always costlier, much costlier as compared to the government funding. And these two major factors, we believe, are not very conducive for a private player to invest in metros.
The markets have rallied for 7 straight sessions, with select index heavyweights like Reliance, Infosys, and select financial driving the index higher. The action today will shift to Hindustan Unilever and cement companies. Let us see what is in store.
The markets extended their winning run to a 7th straight day yesterday on the back of aggressive buying in metals and select IT and financial shares. The BSE Sensex scaled a fresh summit at 61,963 and ended 460 points higher than its previous close at 61,766. The NSE Nifty 50 finished with a gain of 139 points at 18,477. Metal stocks, especially steel, will continue to remain in limelight today. Analysts expect the momentum in metal stocks to continue against the backdrop of a rise in steel prices, which have gone up by 1,500 to 3,000 rupees per ton. Yesterday, the BSE Metal Index had ended with a gain of over 4%. CRISIL, for instance, sees an improvement in the operating margin as well for key players going ahead. There is room to raise domestic prices further, and a correction this quarter appears unlikely as prices are likely to hold. Rising raw material prices in China and the expected coal or power shortage will potentially weigh on the earlier anticipated price correction. Now, talking of the results season, here are the companies that are scheduled to announce their September quarter numbers today. ICICI Prudential, Nestle India, L&T Technology Services, Mastech, Navin Fluorine International, JSW Ispat, HUL and ACC. Among this lot, analysts expect HUL to post low double-digit revenue growth in the September quarter at between 10% and 15%, while its bottom line may rise by 8 to 10% on a year-on-year basis. A drop in prices of cement due to a weak demand coupled with input cost escalation is expected to keep EBITDA of the domestic cement industry muted for the September quarter. While ACC is expected to be a laggard in the September quarter, other larger peers like Shree Cement, Dalmia Bharat and Ambuja Cements are expected to report mixed trends. For ACC and Ambuja Cements, July-September represents Q3 as they follow a January-December accounting year.
You may have heard mixed reviews about unit-linked insurance plans, ULIPs. But do you know what ULIPs exactly are and how they work? Are they a good investment instrument? If so, why? Let us decode all of this in this next segment.
When you think of investing, the first thought that you have is investing in conventional instruments like fixed deposits or gold. However, you might want to check out more modern financial tools like ULIPs, which offer better returns and also offer insurance coverage. A unit-linked insurance plan or ULIP is a product that offers both insurance protection and investment returns. It serves as a great tool to get security and manage your finances. So, the next obvious question that comes to mind is, how does it work? Well, when you pay a premium for your unit-linked insurance plan, a part of the premium is utilized for your security, while the other part is used for investing in certain funds, wherein it helps in developing your wealth. The investment portion of your premium will be put in certain units, which you can select according to your preference, requirement, and financial management plans. Now, let's talk about the difference between a traditional term insurance plan and ULIP. A traditional term insurance plan tends to be opaque. You have no clear idea where your funds are allocated. You may also not have proper knowledge of the returns that you receive or the distribution of your premium amount. On the other hand, when you have a ULIP in your name, you are able to enjoy full clarity. In your ULIP policy document, you find all the details about your policy, such as policy administration charges, policy allocation charges, policy redemption charges, policy switching charges, policy returns, and more. Now, many people tend to get confused if they should invest in ULIPs or mutual funds. The main difference between the two that proves ULIPs are a better choice for investment is that mutual funds do not offer an insurance cover. Also, all mutual funds do not give you tax deductions, whereas all ULIPs provide tax benefits. A few years ago, ULIPs' popularity had begun to fade, as some private life insurers launched certain ULIPs that unnecessarily involved enormous commissions ranging from 60% to 100% of the premiums paid for the first year. This introduction of massive commissions led to wrong ways of selling ULIPs, and it even led to financial scams. But in order to revive the benefits of ULIPs, the Insurance Regulatory and Development Authority of India introduced new measures. The quality of ULIPs was brought back again, and they started to cater to the needs of investors looking specifically for long-term growth. Now, the most important question is what you should keep in mind while selecting a plan. With digital finance at its best, you can compare various life insurance options online, including ULIPs. You can even apply for a ULIP online. You may also check out some features that come with the new age ULIPs, such as systematic monthly plans, systematic withdrawal plans, and systematic transfer plans. These features assist you in boosting your wealth and planning your retirement funds. A ULIP is a good long-term investment that also offers reliable protection to you and your loved ones. It is also flexible and gives you an opportunity to satisfy your risk appetite in a relatively safe way. However, it is always a good idea to consult an expert before investing.
That is all we have for you today. We will be back with more news and analysis. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.